Welcome to Pimpy's Investment Chat, where we keep investment talk simple. And here's your host, Pimpy.
What is going on out there, peeps? All right, I know for years I've been talking about people should be investing in the gold and silver, and there's a reason for it. But if you weren't paying attention last time, you should be paying attention this time more than ever. Let's get into this. Before we get started, do me a favor, hit the thumbs up button. If you're not a subscriber, please do so, because when you do, it helps out the channel, and I certainly do appreciate it. If you're thinking about buying gold and silver, head on over to our friends at Miles Franklin. The link will be down below in the description. When you make your purchase, make sure you use promo code Pimpy, P-I-M-P-Y, and they'll take care of you. If you have any additional questions, you can reach us over here at this phone number or over here at this particular email. For all orders over $10,000, reach out by email and we'll make sure that you get a great deal. So come on over to Miles Franklin and add to your precious metal inventory. All right, just a quick glance at what's going on with cryptos. It looks like they're rebounding a little bit. Man, they've been hit kind of hard. Bitcoin, though, is still at $62,664. Ethereum is at $3,029. Solana is at $136.19. XRP is at 49 cents. Dogecoin is at 14 cents. Cardano is at 44 cents. Shiba is at 402. Polkadot's at $6.63. Chainlink's at $13.44. Polygon is at 66 cents. Litecoin is at $79.97. Terra Luna Classic is at 301. And Chain is at 2015. It's down 1.41% today. Congrats to Chain, who was just awarded, by the way, it's a prestige global blockchain award for best blockchain startup of the year. So congratulations to Chain. So gold is currently at $2,396.40 per ounce. Silver is at $28.34 an ounce. So at the beginning of 2024, the world was at $307 trillion in debt and elevated interest rates. That's the entire world. If you break it down and look something like this, the United States, it's crazy. The U.S. makes up more than 1/3 of the world's government debt at $33.2 trillion, which is higher now. I believe it's at 37. China at 15.13% of the world's debt. A large share of China's debt is issued by a local government financing vehicles to fund infrastructure projects. While China is over there making themselves better, the United States hasn't done shit to fix their infrastructure, but we continue to grow more and more in debt. Bad policy making decisions by certain political groups that we won't name, the Democrats, is causing a lot of damage. I mean, come on, why would you raise minimum wage to $20 an hour when the world is having a hard time just getting by? When you raise minimum wage, what that does is closes down business. That means jobs are taken away. Tech companies all over the place are laying off by the thousands, not just by thousands, by tens of thousands. But yet they're trying to tell us that the US dollar is strong and the stock and the economy is all great. Inflation is looking good. Isn't that what they tell us? I showed you guys the other day, this is the real inflation for Biden. I mean, these are ridiculous. Energy is up 38%. Gasoline is up 47%. Electricity, 29%. In California, it is 42%. Natural gas, 26%. Groceries up 21%. Eggs are 49%. Look at these numbers, you guys. That's what's happened under this administration. Seriously, just take a look at the two comparisons. See, the IMF's fiscal monitoring for spring meeting 2024 discusses fiscal policies in the context of the great election year. According to the report, global public debt edges up 93% of GDP in 2023 and remains 9 percentage points above pre-pandemic levels. Public debt and deficit have been rising despite sharp declines in 2021 and 2022. In 2024, a record number of countries are holding elections, increasing uncertainty about fiscal tightening. Global public debt is projected to approach 100% of GDP by the end of the decade, primarily driven by China and the United States. Local fiscal policies in the United States exerts upward pressure on global interest rates and the dollar, pushing up funding costs in other countries and exacerbating existing fragilities. When the Democrats give you that open border and we end up taking care of other people's issues instead of taking care of our own people, well, your debt's going to increase, and it's only going to get worse. Modest fiscal tightening is expected over the medium term, but it will be insufficient to stabilize public debt in many countries. Under current policies, primary deficits will remain above debt stabilizing levels in about a third of advanced and emerging market economies and almost a quarter of the low-income developing countries by 2029. Higher real interest rates and lower medium-term growth prospects add to the debt pressures. For low-income developing countries, fiscal tightening is particularly important to safeguard public finances, and they face significant scarring from the pandemic and limited financing options. Here's what people are not talking about. I mean, they are talking about it between gold and silver bugs. We hear about this news. We listen to economists talk about this, but the mainstream media is not picking this up. How do you suppose the countries are going to pay for their debt? You are going to pay for their debt. That's why I keep telling people, man, get ready. You're going to see one of these days you're going to wake up, all of your things in the bank are going to be wiped out. They're going to take it. Your 401ks, your IRAs, your savings, your checking accounts, whatever's in your safe deposit box, they're just going to take it. And they're going to tell you it's for the betterment of humanity. And that includes cryptocurrencies. You guys remember, cryptos are in the system. You got to cash them out somehow. How are you going to buy things? Well, when you cash them out or even when you buy them, you got to go through your bank because you have to pay the money from somewhere to buy those cryptocurrencies on these exchanges. As somebody telling me, well, Pimpy, what you do is just keep the cryptos and don't sell them. Well, how are you going to use them? Well, use them like currency. Okay, what stores? Can you go to your local store right now? Think about where you live. I want you to think about this and you own cryptocurrencies. Think about this. If you don't want to cash them out because it ends up in a system and they take your money and you say to yourself, I'm going to do like the other crypto people, I'm going to keep my cryptocurrencies, okay? And I'm going to use them like currencies. I can go around and buy whatever, okay? Think about where you live. Think about where your local store is, your local gas stations, local restaurants, your local clothing stores. Are they currently accepting cryptocurrencies as a form of payment? Are you able to go in there with your magical crypto card and buy things? I would venture to say that probably at least about 92% of you are nowhere near anywhere where you can use cryptocurrencies like a real currency. So just keep that in consideration. One of the biggest issues that the United States has, countries are dumping U.S. Treasury bonds. That used to be a safe haven, but nobody has any faith in the United States anymore just because everybody believes we're on the brink of a civil war. When countries dump U.S. Treasuries, here's what happens. Countries dumping U.S. Treasury bonds can have significant implications on the global economy and financial markets. When countries such as China reduce their holdings of U.S. Treasuries, it can lead to several outcomes. The impact on interest rates. One of the immediate effects of countries dumping U.S. Treasury bonds is the potential increase in interest rates. As these countries sell off their holdings, the increased supply of bonds in the market can push bond prices down and yields up. Higher yields on treasuries would mean higher interest rates across the economy, affecting borrowing costs and businesses and consumers. Nobody wants to hold on to U.S. debt anymore. Like I said, they have no faith in this country. Bad policies, bad money management, spending way beyond our means, giving money to everybody around the world like it's candy, allowing people to flood into our country instead of taking care of our own first. This is all contributing to what's going on. Currency depreciation, large-scale selling of U.S. treasuries by foreign countries can also put pressure on the U.S. dollar. When countries like China sell off their dollar-denominated assets, it can lead to a depreciation of the dollar against other currencies. A weaker dollar could impact international trade dynamics and potentially lead to currency fluctuations. Remember, they're trying to convince us that a dollar is more powerful than ever. It's false. It's being propped up with false data. You could look at this inflation right now. Is your dollar out there buying you more goods than you ever had before? Are you even close to maintaining the lifestyle that you had before this new administration took over? Do you feel like your dollar is buying you more goods or less goods? Market volatility. The sudden drop of U.S. Treasury bonds by countries could create market volatility and uncertainty. Investors may react to such actions by adjusting their portfolios, which could trigger fluctuations in the bond prices, stock markets, and other asset classes, especially in gold and silver. We're going to see them take off like a bat out of hell. Risk to U.S. economy. If multiple countries decide to dump U.S. treasuries simultaneously or in a large quantity, it could pose a risk to the stability of the U.S. economy. The selling pressures on treasuries could disrupt financial markets and undermine confidence in the U.S. government's ability to manage its debt. You have one political party spinning like a bat out of hell and the other one too weak to do anything to stop them. Global financial system impact. Given that U.S. Treasury securities are considered a safe haven asset and several as benchmarks for global financial markets, Widespread dumping of these bonds could have repercussions beyond just the United States. It could affect investor sentiment, capital flows, and overall market stability worldwide. How are the powers that be setting themselves up for this crash? We know what's going on. So what do we see happening with the BRICS nation? Banks, particularly those in the BRICS bloc of countries, have been purchasing large amounts of gold. The top buyers include Singapore, Turkey, China, India, and Russia. The People's Bank of China is a leading net buyer. Russia's gold purchases are linked to Western sanctions and its increasing reluctance to use U.S. dollars in international trade. The motive behind these purchases is attributed to geopolitical pressure and economic risk in the global environment. Central banks view gold as an important component of their reserves due to its safety, liquidity, and return characteristics. As such, they are significant holders of gold. What I used to say? Don't do as they say, do as they do. BRICS countries are shifting towards gold as a reserve asset that can back up their international transactions as they move towards multipolarity and seek ways to strengthen their economies without reliance on the US dollar. This is going to really damage the US dollar. So what are the patterns and trends that we have noticed? Central bank gold purchases over the last 5 years. In the last 5 years, central banks have been actively purchasing gold as part of their reserve asset management strategies. The trend of central banks' gold purchases has been on the rise, with significant buying volumes recorded annually. Here is a breakdown of how gold has been purchased by central banks over the past 5 years. Let's just start down here. 2019, we saw central banks' demand for gold remain robust in response to geopolitical economic challenges. Various central banks around the world added to their gold reserves during this year. Now, this gold purchasing by the BRICS nations has been going on since the 2008 crash. In 2020, amid economic uncertainties and market volatility, central banks increased their holdings of gold. The role of gold as long-term store of value was highlighted during this period. 2021, specific details for individual central bank purchases in 2021 may vary. Central banks continue to show strong demand for gold as a safe haven asset. 2022, central banks globally posted their largest ever annual purchase of gold, estimated at 1,083 metric tons. The People's Bank of China was a significant buyer in 2022 as well. Last year in 2023, People's Bank of China added 225 tons to their gold reserves, making its highest single year of reported additional since 1977. National Bank of Poland bought 130 tons of gold between April and November. That's just between April and November, exceeding its previous stated target. Monetary authorities of Singapore added 77 tons to its gold reserves. Every year for the past few years, all the central banks together continue to break the previous year's record for amount of gold purchase. What does it tell you you should be doing? If you can't afford the gold, then buy the silver. Because if gold goes up, it's going to drag silver along with it. So Jim Willie over here on Arcadia Economics. I'll leave a link for Arcadia Economics YouTube channel so you guys can go check him out. Go over there and see Chris Marcus. He has a great YouTube channel, so I encourage you to go join him. Anyways, in this video, we're going to have Jim Willie talking about gold as a safe haven, and there's no escaping the debt default. Listen to what he has to say about gold.
Which means they need the rate hike and a rate cut. They need a rate hike and a rate cut. Okay? They have no way out. And that's why I focus on my top reasons for the gold market. Gold is the safe haven when there's no way to avoid the debt default.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics, and excited today because, as you can see, joining me is one of our most popular guests on the show and quite a legend in the gold and silver space and internet world, who has been digging into a lot of the things that we're now more rapidly seeing play out in the world. And Jim has been talking about these for quite a while, and a lot going on. Obviously, we had escalation with Iran and Israel over the weekend in the midst of quite a stunning gold and silver rally, which had a big reversal on Friday. I'd be excited to get Jim's comments on that, as well as a bunch of other things. And joining me is Dr. Jim Willie, editor of the Hat Trick Letter, which can be found on golden-jackass.com. And Jim, I guess this is going to be a quick interview today. I heard you have little to say on any of these non-exciting events that have been happening lately. So we'll
Not
get
much
a
happening.
couple of minutes, wrap it up, and
Well, you know, I think 30 seconds for each of the 4 different events, and I can't think of more boring time. I fell asleep just reading about gold yesterday because it was so uninteresting. I just saw for the first time a chart, and I don't know who to give credit to, but it was the delta. I've been calling it the delta, how Shanghai is above the COMEX and London gold price. And it's $58 higher now. Okay, this has been jumping around. But in all seriousness, this is the most exciting time I've ever seen in the gold market. This is the most exciting I've ever seen. It's like we have a perfect storm. We've got the Treasury bond and government debt default. We've got monetization and the resulting price inflation. We've got a big historical wealth transfer where foreign nations are swapping out treasuries for gold. We got big banks that are in trouble. We have the BRICS that are de-dollarizing and looking for multiple options. We've got weaponization of the dollar that's been going on for about 8 or 9 years, and resentment and blowback. We got central banks in a hidden manner loading up on gold. I think the central banks are going to send us to 5 and 10,000. I'll be very plain. We've got, I think, the growing sense of an inflationary depression in the United States. So we're going to have to lower rates, even though that'll be deadly. We've got a war specter. We're not in a global war. We're in a multiple regional war risk. Ukraine, Gaza, Central Africa, Taiwan, and we've got like a civil war starting in Western Europe. Pardon my voice.
well, other than that, it's going great.
Chris, I have to lead with the Japan case study. This is given no Western press coverage, none. I was awakened to it last October and November when the yen concluded a 22% decline. And I'm going to be really simple, and I'm not going to explain a lot of the complexities. I'm going to get really simple. Back in the end, toward the end of 2021, if you could do a 5-year, that would be great. Okay, very good. Notice toward the end of 2021, the dollar was around 110, 112 yen in October, actually. If you could get to October. Okay, 113. And in the next 12 months, it got up to close to 150. Look at that peak. It looks like it's right around September. Yep. It's right around 150. What Japan realized was a 22% decline in their currency. This is the dollar going up. This is the yen going down. Why did the yen go down? I'm going to talk in yen terms. The yen went down because they sold $180 billion worth of treasuries in a 12-month period. That's $15 billion a month for a year. Now, here's the paradox, Chris. The Japanese sold treasury bonds and the yen went down. The Japanese sold a lot of dollar instruments and the dollar went up. Okay, this is a paradox. The yen went down because they reduced their dollar-based reserves as foundation for their currency. All Forex currencies have a dollar basis. When a foreign central bank sells treasury bonds and exits the dollar from the proceeds. They reduce their dollar reserves and their currency goes down. Japan sold $180 billion worth of treasuries and their yen currency lost 22%. Now, here was the after effect because it caused shockwaves. It caused a tsunami because foreign holdings of the Japanese government debt, called the JGB, Japanese government bond, they lost 20% and they started dumping the Japanese government debt. So the Japanese had to react. They printed money to cover their own abandoned foreign held debt of the Japanese government bonds. That caused the yen to go down another 3 or 4%. The Japanese central bank decided we need to abandon our support of the treasury bond and fortify our currency with gold. So now the Japanese are now de-dollarizing in a manner far more effective and thorough than the BRICS nations. The Japanese are now more in tune with the de-dollarized theme of the BRICS nations than the BRICS nations are. The Japanese have not ended their crisis. They're still struggling with trouble in their banks, trouble with their government debt, and trouble with their yen currency. What it means is that a Toyota is going to be cheaper in the United States.
Here's something to think about. Most of our monetary policies here in the United States anyways are dictated by the Federal Reserve. They tell our government what they want and the government obliges by it. If we've been getting into this much financial trouble, especially we keep seeing financial crises happening more and more frequently since we turned everything over to the Federal Reserve, then don't you think the problem is the bankers? They keep getting filthy rich while the countries get poor. It's time for the United States and countries all over to get rid of their Federal Reserve banks and open up a national bank. But every time a country tries that, a war breaks out.
They don't want the treasury bill. They don't want T-bills. So we're left with a conundrum at the West Coast. The Japanese want to sell us cheaper Toyotas and Hondas and Nissans, and we don't have proper currency to pay them. Okay? They don't want our treasury bill. The Japanese now have provided an example. This Japanese case study, in my opinion, has rendered Operation Sandman.
Sorry, couldn't resist.
In a required state for revision. Let me give some background. A year ago, we were told that the BRICS had a devastating plan of Operation Sandman. They were going to have 20 different countries sell $2 trillion in treasury bonds in a 2-day period or a 24-hour period. I like 2-day because I'm working the 2 theme here, Chris. 20 nations, 2 trillion, 2 days. The Japan case study has shown them if they do that, they risk a lot of problems, a very important and powerful crisis in their own home country and banking system. So here's my revised Operation Sandman. At least 20 countries, at least 2 trillion in at least 2-year period. We've got a very, very long gold bull market. We're going to be over 2,500 in the next couple of months. It could be a couple of weeks at this rate. Expect a pullback. I don't get caught up in pullbacks and movements. It's kind of like, I give this argument to clients and colleagues who get on my case. Jim, why aren't you watching the daily movement?
No, listen to what he says, because this is what all of you should think about. When you constantly watch the gold and silver prices, listen to his example.
For the same reason I don't watch my son's monthly growth. I don't mark it on the wall. Every few months he's taller. And in 3 years he'll be my height. I know my son, my boy, is going to be 6 feet tall in 5 years. Why do I need to watch it every damn day? Okay. The revised Operation Sandman is now part of the BRICS agenda. They have not launched a massive treasury bond sale. They're realizing they can keep the United States off guard, off balance, and vulnerable by doing steady, relentless treasury bond sales. And as they do so, they're going out of the dollar entirely. They're buying gold. And the biggest question is, who's selling the gold to the foreign nations? I think it's China, Russia, the Chinese dynasties, the Persians, Iranians, and the Saudis. They're selling gold. The surprise to me was the Persians and the Saudis. When they signed on to the BRICS, they promised to be sources of gold for the BRICS nations. You know, we got an interesting phenomenon now, Chris. I don't even care whether BRICS is signing on more nations. What they're doing now is they're creating a parade of de-dollarization. And after the parade moves well along, a recognized member in the parade will be invited to join the BRICS. And if they say no, it won't stop their de-dollarization. De-dollarization is a way of describing the global gold bull market demand. They're selling treasuries, they're buying gold. Foreigners hold $7 trillion in US treasury bonds. But I was told they hold $34 trillion, Chris, in treasury bonds, corporate bonds, and stocks. They own more stocks than they own bonds. And if you're looking for who is the big holder of US stocks, it's the Swiss Central Bank, the Swiss National Bank. And that's where they're laundering narco money. Narco money is going into the FANGMAT stocks. Facebook, Apple, Netflix, Google, Microsoft, Amazon, Tesla. Narco money through the Swiss is going into the US stock market, creating, let's say, fascist icon managers like Bezos and others. I like picking on Bezos because I think he's scum and a traitor and a fascist.
Jim, what do you make of how some of these guys have actually been selling some of their stock holdings in the recent months?
I think they sense a treasury bond default and a US government default, and the ripple effect will be hit in the stock market.
That's why they're selling off their stocks. A lot of these CEOs and presidents and execs of their companies are selling off their own stocks. Usually what happens is they make themselves cash ready after the market bites the dust and stocks drop. They benefited from when the stock was at its highest. They sell it. They wait for the market to bottom out. Then they take their money and immediately start buying back into stocks they think are going to go up. That's how the rich get rich and the poor stay poor. Right now is the time to take your money out of your bank and put it into precious metals so that you're ready for the same thing they are.
If we have, okay, I'm going to be clear because I'm being misquoted, Chris, not by you. Here's the misquote. Jim really thinks the treasuries are going to default in June or July. No, I didn't say that. What I said is we're going to have talk. We're going to have debate on whether there's a treasury default in progress this summer, June and July. We're going to have talk and debate. Now, I've learned a long time ago that when they debate something and deny something, it's usually happening in the background. So I believe we're going to have a lot of discussion, a lot of debate, a lot of angst, a lot of foreign resentment. Foreigners are going to say, you're never going to pay us back. You're never going to redeem these bonds. What the hell is going on? And quietly, they're going to get 70 cents to the dollar, which means the default is in progress. The indication that the default is in progress is the 70 cents per dollar. And I was told in 2016 if that was happening, if the central bank wanted the treasury bond proceeds in their own local currency. And I was told that South Korea did that. For some, not all, some. That's a debt default. That's a bond default, technically speaking. Okay. I believe this bond default, Chris, has been going on for at least 4 years. I was telling people a long time ago, you're not going to see gold and silver go up until the treasury bond default is near at hand and nearly visible and discussed. We're here now. Pardon me, I've got something in my throat. I cannot get rid of it. This is a very dangerous time because we're not going to be able to pay back our debt. We're probably going to monetize it. Now, a lot of people don't even know what that means. They think, well, that's a nice term. Well, it's about as obscure as quantitative easing. Quantitative easing means we print money to cover our debt and we buy the long end. We print money and buy the 30-year and the 10-year treasury. That's what Chile did when they had 100% price inflation 30 years ago. All right, we're not going to get 30% price inflation, but we might get 15 again. I said again because that's what we had in 2011. I don't believe the official statistic. They're wrong by 6 and 7%. And if you subtract the economic growth by 6 or 7%, which is the lie on price inflation, you see that we're in a depression. Okay. Chris, I think there's something really big going on with the petrodollar, and it needs to be put on the table and discussed. Can we make that transition?
Sure, although if I could just ask one question on something you just mentioned there, where the idea of getting another wave of inflation, which I'm not sure if you've seen that paper on fiscal dominance that was published by the St. Louis Fed, who I might add that you were saying should hire you, which would be great. Heard you mention that in a couple of your other interviews, but basically the concept that as you get to a certain portion of debt to GDP, as that gets big enough, whether you lower interest rates, you get more inflation, or because the deficits, debt expense keep growing and create a feedback loop there, that you could raise interest rates and you get more inflation too. And where I'm going with that is that even with the rally that we've seen in gold and silver over the past 2 months, still very little American participation. And I know a lot of people wonder if we get to the point where Americans on a broader scale are trading paper dollars in for gold and silver. And I think we're a bit of ways away from that in terms of a mainstream audience, although I have wondered if we get, or you could say when we get the next wave of inflation, does that really start to change? I mean, I think people's eyes were definitely opened by what we saw in the past couple of years. And while we may not be at that point where there's a broader awareness of that, I do wonder if there's some point where the prices start going up again. And then you add in that now we see gold and silver in Costco, so somewhat re-entering the mainstream consciousness a little bit. And do you see an environment like that where we finally get a bigger, wider audience in the US, perhaps as a response to another severe round of inflation where that does begin to happen?
Yeah, I think the severe round of inflation is in progress. I don't think it's something you have to wait for. I've talked to about 6 or 8 clients and friends, people who went back to the United States, living in Atlanta, back to the United States, visiting here once in a while and going back to Houston. And they say, Jim, my home insurance has gone from $1,200 to $5,000 in 3 years. And then a California guy said, my home insurance went from $1,500 to $7,000 in the last 3 years. So where's the 6%? Where's the 6% CPI there?
So they're lying about the numbers. I told you guys that's what they do. Anyways, I will leave the link for the rest of this video so you can go check it out. If they cut the interest rate, then you get inflation. If you increase the interest rate, then prices go up. They're screwed either way. I think it's less than 2% of Americans even are aware about precious metals or even involved in investing into precious metals. So for those of you who are buying gold and silver, continue to stack. You're way ahead of the curve. Remember, gold keeps its purchasing power. So even though the dollar weakens, it doesn't make a difference. Your gold will not weaken. Look, right now, more than ever, is the time to invest into gold and silver. But like Jim said, you don't need to watch the market prices all the time. You already know that gold and silver are going to go up, not by a little, but by huge leaps and bounds over the next few years. If you're thinking about buying gold and silver, go to our friends over at Miles Franklin. You can either give them a call right here at 844-874-6797. Tell them Pimpy sent you. Or you can email them right here at info@pimpyspreciousmetals.com if you have any questions, and tell them Pimpy sent you. Anyways, I appreciate you guys chiming in. I'll get at you later. I'm out.